thank you very much. I think I am now on camera. I'm going to just give a couple brief comments. Thank you very much, Eric and Jenny, for helping put this together. And thank you, Sedcor, for being a really good partner on these events and other ones we've done in the past. I'm sure all of us are looking forward to be able to do in live, in-person events next year, hopefully. Optimistically, and getting back to something closer to our normal lives. And also thank the University of Oregon for continuing to basically keep me employed to do these kinds of events and work with the community on economic issues. So with that said, I'm going to find share my presentation here, and we're just going to take off on what's going on with the economy. So I've titled this After the Fall, Will the Recovery Continue? Because we're thinking of this year in three separate portions. One was the initial shutdown we all experienced earlier this year in March and April in particular and into May. The second part was the rebound as those shutdowns ended and we started to resume our normal types of activity. And now we're going through the recovery stage. And what our big question is right now is how strong is that recovery stage going to be? How quickly are we going to return to peak levels of activity and employment? And sort of what's holding back the economy and what's driving the economy forward. That's what we want to think about as we get through the next half hour of my part and then another section on Mark's part. So I guess let's start off with the obvious, and that's that gross domestic product here was clearly down quite a bit during this the second quarter of this year. Basically, if you shut everything down, the data goes bad. I don't think this should be a huge surprise. Output was down more than 30% on an annualized basis in the second quarter. That doesn't mean that the economy was 30% smaller. What it meant was that if we continued that pace of loss through the entire year, the economy would be 30% smaller. Reality is that we didn't continue that decline. We'll be talking about that as we move forward. But the first data was clearly very bleak. So another similar data point was initial unemployment claims, which spiked quite a bit higher in March, basically getting to about 7 million new claims a week. And that's traditional unemployment insurance, doesn't include the pandemic insurance assistance fund for workers not traditionally covered by initial unemployment claims. That's roughly 10 times higher than the worst of the initial claims we saw during the Great Recession. Now I'm kind of mix up Great Recession and Great Depression a little bit. So that's a substantially worse outcome. Initial unemployment claims have been dropping over time and are now around 1 million claims a week. That's still too high, but we're certainly moving in the right direction. I expect that number to continue to fall. Unemployment shot up to a level that we haven't seen since basically the Great Depression this time, well in excess of what we saw during the last recession, but it has obviously started to come back quite strongly or quite quickly back to something that was less than what we saw during the worst of the Great Recession. And I expect that to continue to decline as well. So even though our first data was very bleak, we're already seeing some improvements in the data that we should really be paying close attention to. Now, this has been the same for Oregon overall. Mark's going to talk a little bit more about the Oregon economy, so I'm not going to spend as much time on that right now. When I look at the University of Oregon Index of Economic Indicators, and of course I thank KeyBank for their sponsorship of this work, what we see is a sharp drop in activity in March and April and in May of this year, and then we start to see that rebound. So the rebound is typically consistent with the end of a recession or predicting the end of a recession. So there's a big question I would say about whether we're still technically in a recession now. The economy did grow strongly in the third quarter, and if the economy continues to grow in the fourth quarter, which I expect, then really the recession was a second quarter event. And so that's something where we have to talk about or discuss over the next year is really what constitutes the recession. One other point of this is this measure is designed to be a leading indicator. There weren't any really leading indicators for this recession. It's very different than past recessions. In past cases, we could sort of talk about the data for 6 months, a year, 2 years, even, and debate whether a recession is coming and what policy action should be taken to forestall that recession. This was just a recession hit because we turned off the economy. When I look at the Oregon Measure of Activity, Economic Activity, also sponsored by KeyBank, what we see is that activity, sharply slowed earlier this year and then has rebounded to something closer to normal in recent months. So this again consistent with this idea that the recession itself was very sharp, but also potentially short-lived as far as the technical recession of the down a period of time where growth is actually negative. To see sort of how the rebound happened, we can look through a couple indicators. So retail sales, excluding food services, autos, gas, and building materials. These are, this is what we call core retail sales. Food services, essentially, we're going to talk about it a little bit later. Autos are captured in other parts of the GDP data, so we kind of remove them from the sales data. Gas can be volatile, and building materials is also captured somewhere else. But when we look at this core measure of retail sales, what we see is that it dropped dramatically, but then, boom, started to come back up, and is actually above trend right now. And I wouldn't expect it to continue to grow much until we kind of return to its old trend. But that just shows you how quickly some of this spending returned. We're seeing this catch manufacturing activity more broadly too, where you're seeing really good indicators that new orders are up, production is up, the supplier deliveries are down, which you'd expect really if the economy is starting to actually has sped, it went down and sped back up as the supply chains issues started to work themselves out. Employment index, though, is still a little bit low, and we'll be talking about that and whether that's going to improve going forward. Another sign of really how quickly this recovery has been, we can see in motor vehicle assemblies. So there's two stories here. If you see the huge difference between autos and trucks, right? So the move away from sedans and toward SUVs over time. But if you look at what happened in motor vehicle assemblies during the Great Recession, so that's the 2007-2008 period, what you saw was a fairly slow decline as we got deeper and deeper into the recession, and then a fairly slow return to pre-recession levels of activity. So it took till 2015 or so before you really peaked out on auto sales. If you look what happened, or auto assemblies, if you look what happening now, auto assemblies just went to zero overnight, more or less, and then rebounded back to previous levels very quickly. So again, you do have to start asking yourself, is this really still a recession? Should that gray bar really be ended a couple months ago? So that's really a good sign. It's also the services sector that's feeling improvement. We see that in this ISM non-manufacturing indexes. Still, though, employment is a little bit weak, and we're going to see whether or not we have some possibilities there going forward. Right? So we know we had this big bounce in the data, and we know that we're sort of in this recovery stage now. And the question is, to what extent are we going to recover quickly or slowly? And this is a chart from Mark's office. Are we going, basically trying to get an idea or visualize what these possible outcomes are. You notice there's no numbers on this, right? There's no length of time to recovery. There's no percent change from the peak. This is a stylized explanation of what could happen. And we're clearly in the initial bounce back stage. Our issues have always been tied to, do we get rapid growth because there was nothing really wrong with the economy in February of this year, and thus we can rebound quickly? Or do we have fairly slow growth because we have permanent damage to the economy? And those are the two outcomes or scenarios that we're really thinking about at this point in time. So how are we going to see which of those scenarios? Are we leaning more toward a more rapid recovery or a slower recovery? So good news first. I'd like to start with the good news. Business inventories are very low. Inventories to sales ratios have dropped back to where they were prior to the recession. That's telling us that firms really have a lot of inventory catch up to do, and that's going to create a lot of demand in the system, right? There's still a lot of constraint in these supply chains as firms look to try to basically recover from their, the surge in demand and the drop in production they experienced earlier this year. There's certain sectors that we see that very severely. So lumber prices, for example, have been off the charts recently. And that's because firms expected there to be a collapse in building activity and thus rolled back or shut down or rolled back production at some plants. Inventories dropped very low, and now they're trying to play catch up. So the inventory rebuilding process creates a momentum for the economy going forward and potentially fairly fast momentum for the economy going forward. So that's something I'm watching as we move into the rest of this year. Another big factor is the resilience of housing markets. And so this is existing home sales as reported on a national level by the National Association of Realtors. Some really important stuff here. You can see that the existing home sales have really recovered. Part of this is pent-up demand from low sales in April and May. We see this nationally, we see this statewide, I see this locally. This is basically everywhere in Oregon where we see a real rush to housing. Housing strength is typically correlated with expansions or at least very weak recessions. So the continuing gains in housing, I think, are an important signal that the economy is going to continue to improve. We're also seeing this in construction activity. So new single family homes sold is above pre-pandemic levels and I'd say pre-pandemic trend. So the issue here is, I think, people became too pessimistic on housing in this downturn because they didn't understand the strong demographics that are propelling the housing market forward right now. What we have is a millennial generation moving deeper and deeper into their home buying years. And as a result, that's providing a real good backdrop for the housing market. That's probably going to last for 3 or 4 years here and should sustain this market going forward. So that's, again, a real positive move for the market. Builders are feeling that. This is the home builder confidence measure from the National Association of Home Builders, and it is at record highs, higher than we saw during the housing bubble, believe it or not. So home builder confidence super high right now. That should be help propel a housing market forward. New home purchases or just a home purchase generally entails around, studies have shown, $3,700 of additional consumer spending associated with that. So this is a big factor for the market. So that's a good thing. I think it's something we should really be paying attention to as we think about how the economy is going to evolve over the next year. Job openings have been rebounding. So we worry about what's going to happen with people coming off unemployment insurance. Is there going to be a job there for them? I'd say that this is pretty optimistic news, is that there does seem to be quite a high level of job openings in this economy right now. You can compare this to what happened during the last downturn or even the previous one. Job openings fell over an extended period of time, and then only rose slowly over an extended period of time. Now job openings fell. They only fell to 2014, 2015 levels and already back up to 2018 levels. And we remember as we moved into 2018, 2019, job market was really hot. It was hard to find labor. It's not inconceivable that we move into a similar market sooner than expected. So that's something to be watching out for as well. Part of the issue here, and I keep emphasizing this, is there was nothing wrong with the economy back in February. There was no fundamental misalignment, I would say, between some like what we saw in say prior to the last recession. We saw the housing market just go wild and really impact residential investment spending, or in 1999, 2000, we saw the tech market go wild, and we saw that really influence investment activity. There's nothing similar going into this downturn. So there's nothing to necessarily fix, and the lack of things to fix should help us recover on the other side of this. There's another factor here too that I think is important going into next year, and one I certainly would never have expected, say 3 or 4 months ago, and that's how much stronger household balance sheets are. If we look at personal savings, it very much rose out of the park in levels we have never seen before during this downturn. So what happened is that even though people lost their jobs and their salaries went down, the government was basically force feeding us income in the form of tax rebates and better unemployment insurance. That coupled with the inability to spend, particularly early in the downturn, propelled savings higher. And I like to remind people that this is not, this is a flow. So this is how much savings there are every month. So you're adding to your stock of wealth by having more, by your saving every month. So what I try to do in this chart is look at personal saving, and this is in billions of dollars, and this is a seasonally adjusted annual rate. So a monthly number here would have to be divided by 12 to see what the actual number was. And then look at the pre-COVID trend. And that difference is what I call excess savings, right? It's savings above what really should have been expected had the economy not entered recession. So typically we see savings rates rise a little bit during recessions. Nothing like this. This is completely out of the ordinary. What that means is that every month there's a huge excess stock of saving that's building. And it's over $1 trillion now. This would say, basically 13 trillion, but again, you have to divide that by 12 because of the weird way we do these numbers. So that's a huge amount of money that's sitting out there that's not been spent. So where there's another thing going on too, is that people use some of their saving, their income, to pay down loans. So credit cards and other revolving debt has fallen roughly $100 billion during this downturn. So you have basically a huge increase in savings and a drop in debt. So where's it showing up too? Checkable deposits. You've never seen something like this in the data either. Checkable deposits are up $1.3 trillion or so, roughly from where we started. So that's a lot of loose cash floating around in the background that in theory could come into spending very quickly. And the story I've been telling or worrying about, I don't know if worrying about it's the right thing, but thinking about it as an upside risk, is that if you do get a vaccine sort of toward the end of this year and you start to roll it out to the population in the middle of next year, by the middle of next year, and that looks more likely than maybe we thought last year or earlier this year, then everybody's going to want to go to Hawaii at the same time. That's what's going to happen as all this money comes back, flooding back into the economy, into tourism and travel, I think in particular, because that's the sector that's really been impacted and where there's going to be a lot of pent-up demand. So not only did this happen, but by the way, that stock markets are up and housing prices are up. So household wealth should be quite a bit higher in the third quarter relative to what we saw in the second quarter. So that's all the good news and things that are propelling the economy forward, I would say, into next year. Now, there's still some bad news that we have to worry about. And some of that bad news is permanent job losses are starting to increase. Not like we saw in the Great Recession, but they're moving in that direction. That means some of the temporary furloughs are becoming permanent, as I think we see more permanent closures of business relative to temporary closures. Now, I'm not sure how persistent this permanent damage really is going to be. So for some firms, I think it's just a longer period of downtime than they anticipated. So for example, hotels maybe thought they were coming back this year, when maybe their activity would come back next year. So next year that job will be there. So it's not as permanent as maybe we think. Restaurant activity, I think, again, that's another place where you could pick up activity more quickly next year than maybe people are thinking at this point. But there is that fear of permanent damage to the economy. That entails some transition costs. Those transition costs weigh on our ability to grow going forward. Part of the economy is still impacted and impacted for the foreseeable future by the COVID-19 pandemic. So retail sales for food and services and drinking places in particular being held back by sort of our ongoing concerns about being associated with large crowds of people indoors. I think we still have a hard winter to go through ahead of us. Right now we've gotten some relief, although maybe the last couple of weeks not. Our ability to sort of eat outside has compensated for our ability to, or inability to eat inside. So that's something that we're still watching for, and that's why this sector is probably one to be slower to recover. Obviously, other sectors too. Higher education is also dealing with similar types of issues as we move through this year. So that's a sector of the economy. And I would say overall, travel, tourism, leisure, hospitality, those things are still impacted severely as we go through this next year. Now the good news, for better or for worse, is that set of the economy is actually a smaller set of percentage GDP than I think people often associate it with. Going into this, that was only 4% of the economy. So even if you take off a percentage point or two, that's not really a stumbling block to a broader recovery. And again, I do think these firms come back as we move into the next year. But still, that's a weight that I think we're still dealing with, and firms impacted in those sectors are still dealing with. Another question is about fiscal stimulus. 2 or 3 weeks ago, or 2 or 3 months ago, I was clearly on the side of sustaining this fiscal stimulus is crucial, that the reduction in unemployment benefits is too severe for the economy to basically internalize. Now I'm starting to wonder if that's really the case. That we look into this year is that maybe there's more jobs available than I had anticipated, and there's more excess savings to serve as a cushion than I might have anticipated. So we have this question about how much this fiscal stimulus is going to be sustaining the recovery going forward. So that's still out there, something we should be worried about. Now, if, and I think this is a kind of an interesting story to tell, if both the stimulus was not as important sustaining recovery as we feared, and we still get a stimulus package, that is very bullish for next year. Because basically we'll be spilling even more money into the economy than we would have expected. So that's something to keep in mind as we move into 2021. So what's my general message here is that the economy has bounced off the bottom. And we're arguably not in a recession anymore. So a recession is not really a recession is not any period of time below your full employment. I would say a recession is any period of time in which the economy is contracting. It's not evident that the economy is contracting. In fact, it's much more evident the economy is expanding, and that expansion is sustainable. So I think this is going to prove to be a very short-lived technical recession, and people haven't entirely internalized that yet. The consensus has been for a slow recovery. I would argue that there's a lot of upside risk to that forecast, and what we're already seeing right now is the recovery is much more rapid than might have been anticipated. We saw this too. The Federal Reserve held a meeting this morning where they maintain low interest rates for the foreseeable future. If you look at their forecasts are much, much improved relative to what they were in June. Unemployment is expected to come in a lot lower than they anticipated, growth higher, inflation higher. Basically across their forecasts, the economy is improving faster than expected. So I do think there's an enormous amount of upside risk to this forecast. People have not completely internalized the importance of the housing market rebounding. People have not completely internalized the amount of potential excess savings that have accumulated and could come into the economy as we move into next year. Just a little bit of confidence, more confidence in the handling of pandemic, confidence in a vaccine, confidence in any type of therapeutic treatment could be really a factor that propels the economy forward next year. Not every sector is going to really gain from or really rebound as quickly. The sectors that are more impacted by COVID-19, that require dense groups of people to be successful, those are going to be impacted for a longer period of times. So conferences, again, arts and entertainment venues, those kinds of things, going to have another tough winter ahead of them. But I would say the economy is trying to grow around that problem and growing around it a little bit more quickly than expected. I do think that people forget that the economy is a fairly dynamic entity, and consequently we see problems, we try to fix those problems. Right? Housing is booming. That's probably not changing. I think that's a sustained trend going forward. You have heard lots of concerns about, say, foreclosures or the possibility of foreclosures going forward. I'm not as worried about that. One is I think that there are jobs that are starting to open up, and I think that you'll see people being able to get those jobs. And also, this isn't like the last downturn where if you kind of got foreclosed on, there was this massive hit to the financial market, to the bank. There's a massive hit to you personally. Now, because housing markets have tended to be strong and remain strong, and there's an underlying demand for the product, you could, in fact, probably sell your house rather than getting foreclosed on and still walk away whole. So the dynamics are not nearly what they were back in 2006, 2007, where we saw the real severe impacts from the foreclosures. So that's something to keep in mind. And again, watch for that spending surge. I think, leisure and hospitality, these things could be pent up. There could be a lot of pent up demand here, and that could really hit that industry hard in a positive way.